Last Friday, we got what was the jobs report heard around the world and revisions. And so today we're going to answer the question, is the jobs market collapsing? We're also going to check in on second quarter earnings seasons. What is profit growth looking like? We're going to talk about Jerome Powell and the Fed. Will there be a rate cut in September? And most importantly, what does all this mean for your money? Let's dive into it. Now, before we get into the market update, just a reminder to like and subscribe to the channel. This is a free way that you can help the channel continue to grow. We've been doing these videos for over 2 years now. We have a lot of people who are new investors and also a lot of people who are established investors. And this is very timely information. We have talked about navigating a lot of volatility. You don't want to miss a video, and subscribing and having the notifications on is the way that you can make sure that doesn't happen. Thanks. Let's get into the video. So we're filming this video on a Tuesday in early August, and last Friday, as I said at the start, was the jobs report and revisions heard around the world. Let's break down what happened and what it means. So the first thing we want to talk about, for the month of July, 73,000 jobs were created. Expectations going in was for 110,000. That was a big miss. But it was the revisions that really made the markets take note. For the previous month in June, originally had been reported 147,000 jobs created. That was lowered to 14,000. That's a much bigger deal right there. For May, originally 144,000 jobs, lowered to 19,000. So you're talking about two very low numbers with the revisions. Now, there is an analyst named Warren Pies who's a very sharp guy. He posted on Twitter, which is X, and you see here, he said if you went back to beginning in January, every month this year, the revisions have been lower. And you can see the numbers there, 143,000 lowered to 111 in January. February, a big reduction. March, massive reduction in March. April, May, and June. And of course, May and June, much, much lower. So listen, this is a problem. And what happens here, by the way, is the Bureau of Labor Statistics sends out surveys to companies about their payrolls. And one thing that we've heard is that it's a much lower percentage of companies sending in their forms in a timely manner. So listen, this is something that clearly needs to be fixed. Now, were these numbers being rigged? I don't think that was happening, but there is clearly needs to be fixed. Maybe we'll get that with new leadership at the BLS. We will see. Now, here's the big question, though, as a result of this is the jobs market falling apart? So we're going to answer that by looking at some other data, including other data that was in this same jobs report last Friday. So the unemployment rate actually comes from a totally separate survey. It's released at the same time, but here it's asking over 600,000 individuals. So it's not asking companies about their payrolls. The unemployment rate went up in July from 4.1 to 4.2. Now, whereas the jobs created were very, very low, south of 20,000, very low. But look at the unemployment rate. It has been around this 4.2 area for much of the last year. In fact, it was last summer when this started to jump from 3.9 to 4.2, creating a frenzy about, are we going into a recession? Is the jobs market doing really poorly? And in fact, we did a video from our desk in early August where we said, no, we don't think that's the case. And sure enough, in the fall, the jobs numbers got a lot better. But what this shows you here, the unemployment rate of 4.2%, it is staying fairly steady. You don't see this spiking high. That would be concerning if that was happening. So that's point number one we want to bring up. Now, The next thing we're going to put up is the chart that is looking at average hourly earnings. So this is looking for your average employee. What kind of raises are you looking at? This came in at 3.91% year over year, so just shy of 4% wage growth. This had been at 3.6 a month or two previous, so this went up. We like to see this because typically if the jobs market is really melting down, companies are going to pay less and less. You're not going to see wage growth going up. So this, I want to highlight, 3.9% is higher than what it was pre-COVID. So it's at a good level, much higher than inflation, by the way, also currently. So we're seeing what we call real wage growth after inflation. All right. Those were the data sets that were released last Friday with the jobs report. The day before, we had our favorite jobs data set. And for long-time watchers of the channel, you know what this is. This is initial claims for unemployment insurance. We talk about this all the time because this is weekly data, near real-time look at are companies laying off workers. Here is the chart going back basically for 4 or 5 years. And what you will notice is basically since early 2022, this has stayed in a very, very tight range. Multiple times along the way, economists have been calling for recession and have been saying the jobs market is falling apart. And we watch this chart because as long as workers have jobs, they spend money, and that's what drives our economy here in the U.S. Well, look, last week we got 218,000. That is near the lowest level of the year. That's hard to tell from this chart, so we're going to throw up really quickly a year-to-date chart of initial claims, and you can see right there 218,000. This had hit 216 earlier this year. It was the low, so this is much lower than it was just a month or two ago when this was up near 250,000 people laid off who filed for unemployment insurance. So listen, when you take all of this data, what this tells you is, yes, there is a concern that there is a questions about these jobs that are being announced every month, the amount created, and this needs to get better. We need better methods. But when you take a look at the rest of the jobs picture, it is not painting the picture of a jobs market that is cratering, that's falling apart. It still is fairly solid, and the main part of it is there just aren't many layoffs happening. We're very happy to see that. Now we turn our attention to second quarter earnings reports. We got these beginning kind of in mid-July, and we've heard now from most of the biggest companies in the U.S., including all the big tech names and many of the industrial and financial names. And one of the trends that we've seen all year long, beginning from mid-January to mid-February, where companies were reporting fourth quarter numbers, and then from mid-April to mid-May, where companies were reporting first quarter, where that profits have come in much, much higher than what was forecast going into the quarter. And we've talked about in the long run, stock prices go where corporate profits go. So right now, companies for the second quarter have reported and are expected by the time the quarter's over to report 10% year over year profit growth. Whereas coming into the quarter, just a little over a month ago, expectations were for 5% profit growth. Now that's on the back of 13% numbers versus 10% expectations in April and May. And at the start of the year, 18.5% profit growth versus 12% expectations. So listen, all year long, profits have come in much, much higher. This is a big deal. And guess what? We've talked about our favorite companies to listen to are Visa and MasterCard because they have a front seat view of the consumer and consumer spending. Both CEOs said the numbers for the second quarter were very good, and so far in the third quarter, There has been no weakening in consumer spending. Consumers are still spending money. That is very, very good news. One other thing, we heard from Meta, which of course is Facebook, Microsoft, Google, had blockbuster numbers where all the spending on AI, and they are each spending between $60 and $90 billion over the last 4 quarters on AI. And a lot of people were wondering, are they spending way too much? Well, now these companies are seeing it pay off in spades with higher revenue growth, higher profit growth. That is big news. AI is driving the markets higher. We're very happy to see that. Now, that's looking at second quarter, the actual growth rate, and talking about some of the businesses that are doing well. One chart that I doubt you've seen anywhere else, but it is very important. This takes a look at typically companies when they're reporting their numbers and they're talking about the rest of the year. Do they lower the guidance for the rest of the year? Do they keep it the same or do they raise it? What I want to highlight is that what we got for this quarter for the rest of the year in black on the far right, 56% of companies raised their guidance for the rest of the year. If you look in blue, that was back in April and early May when there were a lot of questions around all the tariff things. Only 29% of companies raised their rest of the year guidance then. They weren't sure. But now there's been some more certainty about what some of these rates are going to be. The tax rates, they now know what their tax rates are going to be. And now over 56% raised their guidance for the rest of the year. Very, very good news right there. Now, last 2 charts as it relates to earnings. And we want to look at something that we've talked about before, which is what are corporate profits going to be like over the following 12 months. What you'll notice is that basically from late 2022, this has been steadily going up. Looking at companies in the S&P 500 that were sitting at about $220, $225 per share of profits. This has been going on and is now up here at almost $290 per share. And note, this has been consistently going up. Here's why this is important. In 2023, the stock market did fantastic, though a lot of economists thought there was going to be a recession. 24, also a good year for investment returns, though there were a couple sell-offs along the way. And in 2025, we had that massive sell-off in late March, early April, 22% sell-off in the S&P, but the markets recovered all of that. And this is the big reason over the 3 years why those gains have been so good, because corporate profits have continued to rise in spite the concerns by some of the analysts. And the last thing we're going to tell you about this is taking a look at profit margins. The way to think about this is for every dollar in sales, how much of it, after a company has all their expenses, makes it to the bottom line of what they keep in profits. This percentage, you will notice, has been rising also since late 22, early 23, and is now at an all-time high of nearly 14%. And here's why this matters, because if companies are more profitable and are making more, that means they deserve a higher valuation. And there are a lot of analysts who have talked about the market is overvalued, and they compare what valuations were in the 70s and the 80s. But there really isn't much of a comparison, because back then profit margins were much, much lower than this. Those companies deserved a much lower valuation. So this is a key factor you need to know about. In late July, Fed Chair Jerome Powell, we had the meeting every 6 weeks. They announced there was no rate cut for that meeting. And in the press conference, he cast doubt on rate cuts in September. But here's one notable thing from the meeting. 2 Fed governors dissented, which that had not happened since 1993. They both believed there should be rate cuts. Now, when we got the poor jobs report on last Friday, all of a sudden the odds of a rate cut skyrocketed. We're going to show you how this played out. So on the far right there, you will notice that the odds of a rate cut were sitting about 70% going into Powell's meeting. After hearing him speak, it dropped down to 40%. You can see that decline there. And then notice this has sprung much, much higher. And as we're filming, this is at 90%. In other words, a lot of investors believe that the Fed's going to have to cut rates because the labor market is significantly weakening. But I just told you in the jobs numbers that really the numbers are not nearly as weak as that headline number would suggest. So I'm not convinced that Powell is going to want to cut in September. He seemed pretty resolute that he didn't want to do that. The question's going to be, will some of the other Fed board members come and say, hey, we really feel a cut needs to happen because Powell does want consensus. We're going to be keeping a close eye on that. The last thing we want to say around the Fed is take a look at inflation, because Powell was saying he's very worried about the tariffs and the impact they're going to have on inflation. This is taking a look at the inflation rates, the consumer price index. You've probably heard of that year over year. What's inflation doing? The PCE price index, which is the Fed's favorite preferred measure of inflation. And then the producer price index, that's wholesale inflation. What are businesses dealing with? Notice there, for the first two I mentioned, the CPI and PCE, these are a little bit higher than they were a couple months ago. But for the business wholesale inflation, it's at its lowest level all year, 2.34%. All of these rates are much lower than where the Fed funds rate is, up at a range of 4.25 and 4.5. So listen, we believe the data supports that there should be a couple rate cuts right now, but we understand with all the personal attacks and everything, Powell is not wanting to show that he is capitulating. It's a tricky situation. We think at the end of the day in September, the right move is going to be to go ahead and cut rates. And if the inflation data stays in the low twos, there's not really going to be much choice. Now it's time for rapid fire, when I go over a couple key charts that I think you need to know about. And we're going to start off taking a look at and talking about GDP growth. You know, in the first quarter this year, we had growth decline by 0.5%. And we talked about the fact that most of that was because so many companies imported far more than what we export, the big trade deficit, because they were trying to beat the tariffs. That came off of the GDP numbers. And we said there was a key part called real final sales to private domestic purchasers, a fancy way of saying what are consumer spending and what's business investment. That's what matters the most. And they had a strong number back then of almost 2.5%. We said, look, that's really good. This is not a recessionary type number. Well, we got GDP for the second quarter and expectations were 2.2%, came in at 3%, much stronger than it can be expected. That was good to hear. By the way, the Atlanta Fed has their GDP Now tracker. They came in at 2.9, so they almost nailed it on the dot. We're going to talk about them in just a minute. Look at on the far right there in the lighter blue, you see the 3%, and right beside it, 1.2% was the real final sales. We are going to want to see in the third quarter that number go up. If that's the lowest this gets during the year, not a problem. But we do want to see this start to go higher. That's something that we wanted to highlight. Now, I talked about the Atlanta Fed. They track what with all these data sets that come out, where they think GDP is going to be. This is for the third quarter, so looking ahead. And this is sitting right now at 2.5%. And it's greater than 2% when you look at that category I was talking about earlier, real final sales to private domestic purchasers. So we're going to be tracking this. If this stays north of 2 as we go through the third quarter, despite all the questions around what were tariffs going to be, this is going to be good news for your money as we get later in the year. Now, The last chart I want to highlight in rapid fire here is taking a look at the Redbook Retail Index. So this takes a look at retail spending. This is a big category that consumers spend a lot on. This came in, and this is weekly, so this is near real-time data, came in at 6.5%. That was the best number since early April. And you can see this had dropped down a little bit over, taking a look at late May and early June. It was in the low 4s. So we like to see that this has jumped back up to 6.5%. This tells you that consumers are out there spending. And again, they wouldn't be doing that if they were really concerned about their jobs, etc. So when you take a look at all the sum of the data that we went over today, we still believe the weight of the evidence is that the markets are going to be higher over time. Now, it is important to note that oftentimes August and September get more volatile. And listen, after the extreme volatility of early April, May and June, and for most of July, the market went pretty much straight up. So it was due for a little bit of a pullback. Wouldn't be surprised if we got one, but as long as the data continues to be good, and especially the earnings picture is very positive, we believe the markets will be a lot higher as we go later in the year. Thank you so much for watching our video, and especially if you liked and subscribed, we always appreciated that. If you are new to Centera Capital, go to our website. You can go to the contact page and reach out. We have a 3-meeting process to see if we are a good fit for each other. And if your advisor aren't doing these kind of market updates, we'd love to talk to you. Thanks for watching, and take care.